Do you want to protect your wealth from a market crash? Do you want to keep your portfolio intact when stocks collapse? The answer is simple. Hold bonds. Understand their relationship with stocks and use them strategically. Why does it work? This slide explains everything. In 2008, the Lehman shock swallowed the world. The S&P 500 posted a minus 37% annual return, including dividends. Many investors lost more than a third of their wealth. Fear dominated the market. But what happened that same year? A leading aggregate bond index posted a return of more than plus 5%. Long-term U.S. Treasuries surged more than plus 30%. While stocks collapsed, bonds rose. Why? In times of fear, capital flees to safety. And that safe haven is bonds. But there's a critical caveat. This relationship doesn't always hold. When surging inflation and rapid rate hikes collide, as they did in 2022, stocks and bonds can fall simultaneously. That's why bonds are not a universal shield. They're a tool, one you must understand before you deploy it. Today I'll show you the full picture. First, understand what a bond actually is. Simply put, you become the bank. Governments and corporations need capital. You lend it to them. In return, they pay you interest regularly and return your principal at maturity. Here's a concrete example. You purchase a $10,000 bond. Coupon rate, 4%. Maturity, 10 years. What does that mean? Every year, $400 in interest hits your account. After 10 years, your $10,000 principal comes back. Total interest income over 10 years, $4,000. But understand, this is the typical case. Structures like zero-coupon bonds, where you receive the face value at maturity with no interim payments, and floating-rate bonds also exist. And principal repayment depends on the creditworthiness of the issuer. For anything other than government bonds, default risk is real. Bonds are not risk-free, but their structure is transparent and predictable. That transparency is the greatest strength of bonds. There are three primary types of bonds. Understanding each one is the starting point for making smart choices. First, U.S. Treasury bonds, issued by the federal government, widely regarded as the safest investment on earth. Why? Because the historical probability of the U.S. government defaulting is extremely low. Yields vary significantly depending on term and market conditions. Always check the latest yield levels on the yield curve published by the U.S. Treasury. In exchange for that safety, yields tend to be lower than corporate bonds. Second, corporate bonds, issued by companies. They offer higher yields than treasuries, but that comes with higher risk. Unlike governments, corporations can go bankrupt. Always check the credit rating. Notation varies by agency, but the general benchmark is BBB or above from S&P and Fitch, or BA3 or above from Moody's. That's the investment grade threshold. Below that, you're in junk bond territory. High yields, but risk spikes sharply. Third, municipal bonds, issued by states and local governments. Interest on many municipal bonds is exempt from federal income tax. But pay attention. Some bonds are subject to the AMT, the alternative minimum tax. And state tax treatment varies based on your state of residence and the bond's issuing state. They are often advantageous for high-income investors, but always verify your own tax situation. Three options, each with a distinct purpose. The combination is the key. Here's the most critical point. Understand this law that most investors overlook. Interest rates and bond prices tend to move in opposite directions. Why does this happen? Say you buy a bond today with a 3% yield. The next day, interest rates rise to 5%. If new bonds are available at 5%, who wants your 3% bond? Nobody. So the price falls. Now flip it. When rates fall, the value of existing high-yield bonds rises. Here's a benchmark to understand price movement. For a bond with a modified duration of approximately 8 to 10, a 1% rise in yield can push the price down roughly 8 to 10%. This is an approximation. In reality, Convexity and other factors introduce error, especially in large rate swings. Look back at 2022. The Fed hiked rates aggressively. Major indices tracking long-term Treasuries posted double-digit declines, deep into the high teens and beyond. The myth that bonds are safe was shattered that year. There are two ways to defend against this. First, hold short-term bonds. The shorter the duration, the smaller the price swing. Second, hold to maturity. You avoid the price volatility risk entirely. But note, this applies to Treasuries. With corporate bonds, default risk from the issuer remains. Those who understand interest rate risk can manage it. So, what percentage should you actually allocate to bonds? Here's one benchmark. 120 minus your age. That's your equity allocation percentage. The rest goes to bonds. What if you're 30? 120 minus 30 equals 90. That's 90% stocks, 10% bonds. You're still young. You have time. You can take on risk. What if you're 50? 120 minus 50 equals 70. 70% stocks, 30% bonds. Retirement is closing in. You need to strengthen your defenses. What if you're 70? 50% stocks, 50% bonds. Protecting your wealth becomes just as critical as growing it. But understand, this is a guideline, not gospel. More people are using 120 instead of 100 to account for longer life expectancy. But it's an aggressive allocation. If you're sensitive to risk, 100 minus your age works too. Adjust up or down based on your asset size, living expenses, and risk tolerance. Then there's a strategy to make bonds work even smarter, the bond ladder. Spread out your maturities. Set maturity dates at 1 year, 3 years, 5 years, 7 years, and 10 years. Every year, a portion of your bonds matures and cash comes back to you. Use that cash to buy new long-term bonds. This smooths out the impact of interest rate fluctuations over time. But there's a risk to watch. When reinvesting matured funds, if rates are low, you may not achieve the yield you expected. That's reinvestment risk. It's a boring system, and that's exactly why it's the most powerful. I need to be honest about bonds' greatest weakness. It's inflation. Think about it. You hold a bond with a 3% yield, but inflation is running at 4%. Nominally, you're earning 3%. But in real terms, your purchasing power is being eroded by 1% every single year. This is an invisible tax. On paper, your numbers are going up, but in reality, you're getting poorer. Look back at 2022. Inflation surged, and the Fed hiked rates aggressively. The result? Stocks and bonds fell sharply at the same time. TLT, which tracks long-term U.S. Treasuries, dropped more than minus 30%. The S&P 500 was minus minus 18%. Investors who believed they were diversified with bonds took losses on both sides that year. So how do you fight back? The first solution is TIPS. Treasury inflation-protected securities. The principal automatically adjusts in line with CPIU. And interest is calculated on that adjusted principal. As inflation rises, the interest you receive rises too. But pay attention. The inflation adjustment on TIPS may be taxable in the U.S. Always verify the tax treatment. The second solution, shorten your duration. When surging inflation and rate hikes hit simultaneously, short-term bonds and T-bills serve as a temporary safe harbor. Smaller price swings, and you benefit from rising rates sooner. The third solution, combine them. Equities tend to track inflation over the long run. But in the short term, when high inflation and rate hikes collide, stocks can fall too. Don't rely on bonds alone. Combine stocks, TIPS, and short-term bonds to build a multi-layered defense. Those who understand inflation can manage it. Now let's lock in today's critical takeaways. Here's today's summary. First, in many environments, bonds have the power to move in the opposite direction from stocks. When equities crashed minus 37% in the 2008 financial crisis, the aggregate bond index posted more than plus 5%. But this negative correlation doesn't always hold. In environments like 2022, where inflation surges and rates spike, stocks and bonds can fall together. Bonds are not a universal shield. They're a tool, used in combination with duration management and inflation protection. Second, increase your bond allocation as you age. 120 minus your age is the modern benchmark. At 30 to 10% bonds, at 50 to 30% bonds, at 70 to 50% bonds. But this is a guideline. Adjust based on your risk tolerance and asset size. If you want to be conservative, start with 100 minus your age. Third, prepare for the invisible enemy, inflation. If your yield falls below the inflation rate, your real return is negative. Use tips to build in automatic inflation protection. In environments where high inflation and rate hikes collide, short-term bonds and T-bills become a temporary safe harbor. A multi-layered defense protects your purchasing power. How much of your portfolio is in bonds right now? Does that allocation match your age and risk tolerance? Share your strategy in the comments. Your current asset allocation, your questions about bonds, your experience surviving the 2022 simultaneous crash. Every insight becomes wisdom for this community. Thanks for investing your time with me today. On this channel, I break down everything you need to defend and grow your wealth, from bonds and equities to inflation protection and tax advantage strategies, with numbers and strategy. Boring knowledge is what protects your assets from the next crash. If you want that blueprint, subscribe and turn on notifications. See you in the next one.